Hey everyone, welcome back to Corporate Decoder. Today, iQSTEL Incorporated just filed an 8K announcing a $50 million stock purchase deal, and I am seeing a huge dilutive red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is raising a lot of money, but it comes with significant risks for existing shareholders. Alright, so iQSTEL Incorporated filed this report on May 1st, 2026, detailing a pretty substantial agreement they made on the 30th of April 2026. Basically, they signed two big agreements. One is an equity purchase agreement, and the other is a registration rights agreement. They did this with a company called M2B Funding Corp. Let's call M2B Funding Corp the investor for simplicity. Here is the core of it. iQSTEL can ask this investor to buy up to a whopping $50 million worth of iQSTEL's common stock. This isn't a one-time purchase, it is a commitment over a period. Think of it like a flexible line of credit, but instead of cash, they get stock. Now, let's talk about the price. This is where it gets interesting and potentially concerning for current shareholders. iQSTEL can sell its stock to the investor at 94% of the lowest average stock price over a 6-day trading period after they request a purchase. That means they are willing to sell their stock at a discount. Specifically, the discount is tied to that lowest daily volume weighted average price. It's like saying, we'll sell you our stock, and if the price dips during this period, we'll give you an even bigger discount. They've also put some limits in place, like a maximum daily purchase amount and a cap on how much of the company's total shares the investor can own without shareholder approval. This means the investor can't just buy up almost all the company's stock at once. This agreement isn't active immediately. It kicks off once a registration statement they've filed becomes effective with the Securities and Exchange Commission, or the SEC. As a thank you for the investor's commitment, iQSTEL is giving them $1 million worth of commitment shares. Half of these are given out right away, and the other half will be given a year later, or if the agreement ends early. There is also a restriction on how quickly the investor can sell these commitment shares, limiting how much can be sold each day. The other agreement, the registration rights agreement, sounds a bit technical. Basically, iQSTEL promises to file paperwork with the CC so that the investor can easily sell the shares they receive. They have to file this within 90 days and get it approved within 180 days. If they are late, they have to pay the investor penalties. These penalties are calculated based on the total amount the investor could potentially buy, which is $50 million. This sentence is important. It states that there is no other significant business relationship between iQSTEL and this investor outside of this stock purchase deal. This helps show that the agreement is purely for financing. So, on the same day they signed the agreements, the 30th of April 2026, iQSTEL actually gave the investor the first batch of those commitment shares. They are saying they issued these shares without needing to register them with the SEC publicly. This is allowed for certain types of private sales, especially to what they call accredited investors. And the investor confirmed that they are an accredited investor. This is a standard requirement for these types of private placements. These agreements are pretty common in the world of smaller companies looking for funding. They often use these types of stock purchase agreements, sometimes called equity lines of credit. And signing off on this is the CEO himself, Leandro Iglesias. Now let's put this all together. iQSTEL is securing potential funding of up to $50 million. This can be a lifeline for a company, especially if it needs cash for growth, operations, or to cover expenses. Recent news shows iQSTEL has been talking about significant revenue goals, aiming for $317 million for fiscal year 2025 and expanding into AI and fintech, so they likely see this funding as a way to fuel that expansion. However, there is a big but. Selling stock at a discount, especially with potential for further discounts based on price drops, is a clear sign of potential dilution for existing shareholders. When new shares are issued at a lower price, the ownership percentage of current shareholders goes down. Imagine if you own 100 shares out of 1,000 total shares, you own 10%. If the company issues another 1,000 shares at a lower price, and now there are 2,000 total shares, your 100 shares now only represent 5% of the company. This is called dilution. A comparable situation might be companies that have used similar financing tools and then struggled. For instance, some smaller companies pursuing at-the-market offerings or equity lines have found themselves in a cycle of continuous dilution. This can lead to a rapid decrease in the stock price, and historically, about half of micro cap companies engaging in such heavy dilution end up delisted or in significant financial distress within a few years. For a $1,000 investment, persistent dilution like this can erode value significantly, potentially turning that $1,000 into a few $100s, or even less if the stock price plummets due to the increased supply of shares. The fact that they can sell shares at 94% of the lowest daily average price in a 6-day window suggests that they might be anticipating or even needing to sell stock quickly to meet obligations. The volume-based caps and daily maximum of $500,000 are attempts to control the pace of this dilution, but the overall mechanism is designed to allow the investor to buy into the company at a favorable price, especially if the stock price declines. The registration rights agreement, while standard, also means the investor will eventually want to sell their shares into the public market, adding more supply. The penalties for delays in registering these shares underscore the investor's priority of being able to liquidate their investment efficiently. From a business strategy viewpoint, iQSTEL's goals in AI fintech and EBITDA expansion are ambitious. This funding could potentially help them achieve those goals. However, the method of funding raises questions about the company's immediate cash needs and its valuation. If the company is truly performing as well as the headlines suggest with $317 million in revenue, why would they need to offer stock at a discount? The biggest risk here is the potential for significant dilution. If iQSTEL's stock price continues to fall, the investor will be able to buy more and more shares at lower prices, which will further depress the stock price and reduce the value of existing shares. It is a bit of a vicious cycle. What I am actually looking for is to see if iQSTEL can grow into this funding and achieve its ambitious revenue and profit goals to offset the dilution. Without significant operational success, this deal could be a major blow to existing shareholders. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.